Hi, I'm Dorian Lamb, and welcome to Season 2 of Start with the Close in Mind. In real estate, business, and life, the people who win aren't the ones who react. They prepare, they think ahead, they see the close long before the rest of the room does. After a year of conversations with top operators and decision makers, this season goes even deeper into what it takes to close deals the right way. We'll break down the strategies, the mistakes, the mindset, and the real stories that reveal how successful people navigate complexity and come out on top. Every episode brings insights from leaders who have been in the trenches and can show you the difference between hoping a deal closes and engineering the outcome from the start. This is Season 2 of Start with the Close in Mind. Let's dive in. Hey there, and welcome to the next episode of Start with the Close in Mind. Today's episode is going to be about value, not appraised value, not what a seller thinks his property is worth, not even what a buyer hopes it's worth. The real value from somebody who's been in the trenches for more than a decade in New York City and now more broadly in the Northeast. What somebody is actually willing to pay for it from their perspective, from what they've seen. One of the things that makes real estate real interesting is that everyone can look at the same asset and come away with a complete different opinion. The market is ultimately what settles the debate. So today, my guest is Chad Sinzheimer, who has spent more than a decade sitting in the middle of those conversations, from investment sales to capital markets advisory. He's worked with owners, investors, lenders, and institutions across multiple market cycles now. What makes his perspective valuable is that he gets to see what actually trades and what doesn't, and then can figure out why, or at least can see why after the fact. Today, we're going to get all into that. So, Chad, welcome to the show. And let's start with your background and how you found your way into this business.
Sure. Nice to be here, Dorian. So, yeah, I've been in real estate for about 13 years, but I've been a trader for my whole career. I spent the first part of my post-college life as a equity options market maker. Started much like the movie Wall Street, or trading places where you saw people yelling and screaming in pits. It was about how aggressive and how fast you were, and opportunity literally manifested itself in seconds. I would do hundreds of trades a day, as opposed to now doing 5 to 10 a year. So a little bit of a different animal. That was a business that fundamentally changed while my course of my being in it. When I started, as I said, it was very much an open outcry environment. It started to manifest itself into a more of a screen-based environment. Electronic trading became something that became prevalent. Government wanted transparency from when a customer would put an order in to what it would actually trade for. And as a result, the marketing business really changed, and it became harder and harder to make money. I did that through the financial crisis of 2008, 2009. Those were fantastic trading years. If not the best years for someone's personal portfolio, and then traded my own capital after trading for a firm for over a decade for a few years after that. And it just got harder and harder to make money. And come around 2012, I just had my first daughter, and I realized that I wasn't having fun anymore. I wasn't making a whole lot of money anymore, and I needed to make a transition. And I grew up here in New York City, and I feel like when you grow up here, real estate's kind of ingrained in you. You watch neighborhoods transform. Fascinating to see all the beautiful things that got created. And it's an industry, much like finance, that has a ton of money flowing through it on a daily basis. And I thought to myself, if I could find my niche somewhere in real estate, I could do very well. So I turned to my financial advisor at the time, said, hey, introduce me to all your real estate clients. I want to pick their brain, take them out for a cup of coffee, see what they like and don't like about their jobs. And this was around 2012, 2013. Investment sales was white hot. Coming out of GFC, in New York City, a lot of investors going into a fix and flip model where they buy multifamily buildings to do some sort of value add program, raise rents, and look to sell it to someone that would look to buy a more finished product. And that was going rampant right around 2012, 2013. It got a little too rampant, which was round up with some pretty substantial prohibitive legislation later in the decade, but we can get to that at another point.
Yeah.
But at any rate, I interviewed with a bunch of commercial real estate firms, found a home at Eastern Consolidated, a firm that was ran by husband and wife duo Peter Hausberg and Dawn Paris. And what really appealed to me there was coming in mid-career, I wanted to be exposed to as much opportunity as possible. Eastern's model was very much eat what you kill. You could go into any asset class, any geography, just uncover opportunity. And in my first year, I sold everything from single family home conversions, multifamily properties, retail properties, office buildings, and development sites. So it looked like a pretty good move. And I was very happy at Eastern. In 2018, they decided to close the doors. They saw a wonky market coming up. Peter and Dawn in their 60s decided they wanted to move closer to their grandchildren out in California. And at that time, I was forced to make a pivot. My partner and I wound up at Ackman Ziff, which is a national debt and equity capital markets firm that was looking to beef up their investment sales practice here in New York City. So we were brought in to build up their sales side of their practice. This was in the summer of 2018. Summer of 2019, you had the Rent Reform Act. 2020, you had COVID. 2022, you had the coming out of COVID, interest rates start to ramp up, and then you have the mess that we're in now. So not exactly the greatest time to build a brand, but I learned a ton at Ackman Ziff. I always make the joke. I came in with my bachelor's in brokerage and I got my master's in capital markets. I learned a lot about what makes deals tick, how they get capitalized, how they get underwritten from an institutional perspective, and valuable tools that I use today. Right around 2024, a former colleague from Eastern who started Adirondack Capital Partners when Eastern had closed the doors in 2018 was getting very, very busy. And he wanted someone to come in and build the practice with him. So at the time, my partner invited me to come in, gave me a piece of the business and said, hey, come build this with me. I want to build the firm the right way. And haven't looked back since. It's been a great 2 years. I'm the managing partner at Adirondack Capital Partners. We're a boutique investment sales shop. I co-run the firm with my partner, Michael Coghill. And what's a little different is I now cover the entire Northeast. Most of my career up until joining Adirondack was focused on New York City. Now I cover everything from Virginia on the south side up to about Maine on the north side, everything in between. We have an office here. I'm actually talking to you from New York City. We have an office up in Albany, a satellite office up in Boston, and anything we can drive to within 3 to 4 hours is what we cover.
Yeah.
Asset class agnostic, so still using a lot of the same stuff that was ingrained in me at Eastern Consolidated and the eat what you kill model, but we have two main core verticals: high street retail and multifamily. High street retail, we have a couple of very unique foreign capital relationships that can get very aggressive for the right high profile opportunity in the right locations. Multifamily, we have a couple of foreign capital relationships out of the Far East, some out of the Middle East, and in Europe as well, that are willing to buy things 10-year plus type hold horizons to up to generationally, which allows them to get a little bit more aggressive on underwriting as well.
Yeah. That's quite the background, honestly. And congrats on the platform that you're leading now. First of all, two great movie references that you made for those who called it Wall Street and Trading Places. But that part of your history did and does fascinate me in terms of your experience as an option trader. And as a good segue to how you go about valuing things and your experiences with that, and specifically with real estate. When it comes to options trading, feedback's pretty immediate, but in real estate, sometimes it takes years to know, whether or not things are trading right. So let's start there in terms of how that's shaped how you look at real estate. Is there any kind of through lines that you see that are similar, or is it completely different? Did it help you kind of, evaluate or see things in a different way?
Well, I think the one thing that I took away from the options career was value is very much determined by the market, right? And that could mean a variety of things. It can be as simple as it's what someone's willing to pay determines value. And we see that sometimes with deals that are user based. For example, a few years back, I sold 2 interconnected townhouses in the West Village on behalf of a nonprofit. It was used as a hostel. They no longer found it financially feasible to run the hostel, and they decided to wind it down. And this was on West 11th Street, which is probably the most premier residential townhouse block in the West Village.
Yeah, I didn't even know that existed. Good job there.
Yeah, yeah. I don't, they don't usually let the normal folks on that block like you and I. Your net worth well into the 8 digits before you get to that block. At any
Yeah.
rate, we had valued it from a conversion perspective, where a townhouse developer would come in, convert the hostel into 2 adjoining single family homes, which would eventually be sold to an end user. And we valued it based on what those single family homes would be sold at, minus the construction cost, minus what premium the developer would require for taking the risk, for taking the project on, or really their profit margin. And that brings you to a value. Long and short of it, the value that I think we went out at, or BOV'd the property at, broker opinion of value, was around 30 million. We went out to submit offers because we knew, given that this block was such a prime residential block, that a user could come along and say, hey, I want to build my own home here or homes here. And therefore, the value wouldn't really apply because they don't have to make a profit. The value to them is in the utility of the asset. And lo and behold, we ran a process, much like our valuation had implied. We got a lot of offers from the development community between 28 and 30 million. So right around where we had valued it. And I'll never forget this. It was right after Thanksgiving. It was on my birthday on a Sunday. And I got a phone call from a random number. And I picked it up and a lady answered the phone. She goes, hi, this is SJP. And I'm interested in the listing that you have on West 11th Street. Can I come take a look at it? And I said, sure, absolutely. We'll set you up for next week. So I turned to my wife and I said, I think I just spoke with Sarah Jessica Parker. And I was like, the voice is pretty much indistinguishable. I mean, or is distinguishable, indistinguishable. But at any rate, I'm like, I'm pretty sure that was her. And the Tuesday of the next week, we met at the property, and sure enough, a petite blonde and a big hat comes down the block, and there she is.
Interesting.
And so we brought her through. She loved it. She brought Matthew Broderick, her husband, through. It turns out they had owned a townhouse right around the corner. They were waiting for something bigger to come onto the market. 50 feet of frontage is very, very unique. It's essentially a double wide townhouse.
Yeah.
And they're like, this is our opportunity to create our own double wide, unique mansion on the premier block in the West Village. So they're like, what's it going to, we talked to our client and we're like, look, this is a user. Users sometimes pay 15, 20% more than where the market is. Let's counter them at a number in the high 30s and see what happens.
Right.
Lo and behold, long story short, they come up to about 35 million and we make a deal there. So we made an extra close to 20% of where the development community was because a user, in this case, a high-profile Hollywood couple, decided they wanted to build their dream home here.
That's a cool story.
So, which they said they would invite me to see once it was finished. They never did. So I'm still waiting to get over there if they're listening, Matthew and Sarah. But at any rate, there's an example of the property being worth what someone's willing to pay for.
Yeah. So I mean that illustrates kind of value and how it can sway so greatly depending on who it is that's buying it at the end, right? So the trick of that really, or one of what I would deem for me in my lens as the difficult aspect is of something you mentioned, which is the BOV or broker opinion of value, where like how technical are you or how kind of speculative are you? Like where do you find that middle ground when you are doing that?
Yeah. So look, it depends on the asset. Different assets, it's a little bit more art than science. Some of them, it's very, very straightforward. For example, multifamily, for the most part, you can BOV and be pretty accurate because it's based on income or potential income. Development is a little bit more art than science because someone could look at a development site and say, hey, I can build this thing cheaper than the next guy, or I think I can get higher sellouts or higher rents than somebody else. Or lastly, I think I can somehow finagle a bigger building here because I have connections with the city to build a bigger product potentially. Right. And therefore improve the profitability of the product that way. So development's a little different. Retail, industrial, for the most part, are pretty straightforward, but we try to BOV everything before we take it out because we want our expectations to be aligned with the sellers and for the full transparency for everyone to understand that when we hit the market, this is where we think bids are going to come through.
Right.
It doesn't always work out that way. Ultimately, much like in the Sarah and Matthew's scenario, the market's going to speak. And what I think the property is worth, and I like to think that my values are pretty spot on most of the time, but sometimes there are circumstances beyond your control and there are market forces beyond your control that ultimately can dictate the value of the asset.
Yeah. So, I feel like the takeaway there is that sometimes value isn't what the owner creates or isn't always what the owner created. It's what the next buyer believes they can do with it or what they can use it for. And I guess it goes back to a term that we hear a lot, which is highest and best use, right? So that's generally where the valuation is component's going to really fall. Let's talk about then what you're seeing in the current market today. So what's the current market reality? What are you seeing buyers focused on now, or what are you seeing that that's the trend for the year?
Sure. Well, look, multifamily is still king. It's the thing that lenders are most comfortable issuing credit on. It's the stuff that's cash flowing and you have multiple tenants so that any dip in occupancy is not impacting your bottom line all that much. So for the most part, well, multifamily is two different, I tell two different multifamilies. There's market rate multifamily, which is abundant demand. And then there's rent regulated multifamily, which is much more of a niche buyer set, especially after the Rent Reform Act that was passed in New York in 2019, that really inhibits your ability to raise rents in any meaningful way on those buildings while expenses have continued to outpace rent growth over the last few years. So those assets essentially are depreciating assets. That doesn't mean that they're not worth anything. It means that they have to be bought with a little bit of wiggle room, and you'll see those trade at much higher cap rates than the free market stuff where you can raise rents based on market forces.
Yeah.
So multifamily is certainly still king of the crop. Development, I mean, look, here in the North, we cover the entire Northeast. And I think what's unique to the Northeast is there is somewhat of a barrier to entry to developing new product. So supply and demand has been very, very much skewed towards the demand side. And that's why you've seen rent growth outsized compared to the rest of the country in the Northeast the last few years. Certainly New York City, you're seeing it. Outside in the New York City metro, we're seeing it. And we're seeing it in places as far as central New York, Syracuse, Rochester, Buffalo. We're three of the top 5 markets in the country last year in terms of year-over-year rent growth because there's no meaningful supply. So anytime that you can find a viable development site in an area where there's a barrier to entry, and New York City certainly qualifies, and a lot of the areas of the Northeast, given bureaucracy, certainly qualifies, there's going to be demand for it. We've marketed, here's another example of something that we've marketed where we saw really good demand for is we sold a development site on the High Line last year on 10th Avenue between 18th and 19th Street, across the street from the High Line. And this was a property that essentially you could build about 90,000 square feet. Given its proximity to the High Line, we thought the best execution was going to be a boutique condo type project, selling out around 28 to 3,000 a square foot, 300 to 3,000 a square foot. And we underwrote the deal, backed into a developer profit margin, and it spit out a value around 40 million. And we went to the seller and said, look, this is where we think this is going to trade. Based on our inputs, we think it's going to be somewhere around 40 million. And they're like, okay, look, we want more than that, but let's go to the market and see what happens. Look, not always the most ideal thing to want to do, but we knew given the scarcity of products or available viable development sites and given the prime location, that there was going to be pretty strong demand for this on the market. So we hit the market. We actually uncovered a quirk in the zoning that unlocked a little bit of additional FAR, which increased the development potential about 20%. So you factor that into our BOV, that adds about $8 million, $48 million. We got bids between 45, 48 million. Ultimately had bids go into the lower to mid 50s and closed at 53 million. So essentially, again, around a little over 10% above where we had BOV'd it. And the reason was it got competitive. People looked at this, they stretched their underwriting, they tried to squeeze as much as they could to justify our higher price, just given the scarcity of available sites and given the location and given that condos have robust demand in this area and a proven sellout comp set, that even though they had to squeeze, that they thought that they'd be reasonably good chance that they'd be successful.
Yeah.
An offer is only as good as the person that's standing behind it. We had offers that were north of where we ultimately closed, but the group we closed with was an institutional developer that's publicly listed on the New York Stock Exchange that we knew had the track record and the wherewithal to close.
Right.
So, certainty of execution and there's no transaction and no commission for me without it is something that certainly comes into play when evaluating offers.
Yeah, for sure. And one of the things that we talked about earlier was, the capital markets exposure and experience that you gained from Ackman. How much is financing influencing buying decisions today from what you're seeing?
I mean, it always influences. I think that's probably the one thing that I learned more than anything at Ackman Ziff was how fine is to ask the question every single time when evaluating an asset is how financeable is it? Because there's certainly some folks out there, some rich people in the world that can pay cash for properties. However, most folks do not want to pay the full sticker price in cash and are going to look to put 70% in a mortgage, right? So that's going to influence things greatly. It also influences your returns. A levered return is much higher than an unlevered return. So financing and where you can find it, what proceeds you can get, and at what rate, that debt service payment impacts your NOI and your bottom line. So ultimately, all that's going to play into what your value is for a property. Interest rates matter for a host of reasons. Financing cost is one of them. It also dictates the risk-free rate. For U.S. Treasuries, right? You can buy those today between 4.5% and 5%. You're buying 10 to 30-year money, right? So if you can buy a coupon at 4.5%, 5%, it's hard to justify buying real estate at a cap rate that's below those numbers when
Right,
there's inherently always going to be risk associated with that real estate.
right,
Even if it's a single tenant that's leased, a single retail box leased to a CVS for 30 more years. CVS could always go bankrupt on that location and pull out. You never know. So you have to always bake in some sort of risk premium above that risk-free rate, which also will impact the value of an asset as the cap rate will trade at a premium to that risk-free rate.
So that's like you said, always going to be the case, right? And I guess there's more sensitivity to it now, given what everybody got used to a few years back, prior to 22, to use your reference, and really in 23 when the interest rates went crazy. So another thing we spoke about is that there isn't really much volume comparative to how it used to be. You mentioned two really successful deals, one in 11th Street, and then now the one across the street from the High Line. Those were some success stories. Let's look at the other end of it now, though, to see and create some contrast. What are some of the mistakes that owners are making now that you see when you represent them?
Yeah. So I knew you were going to ask this, by the way. So look, with multifamily, in particular in New York City, with anything with any kind of regulatory aspect to it, paperwork has become more important than that it ever has before. And what I mean by that is you need some sort of documentation on rent history, expenses, and paid incurred to fix the buildings up. If you justified any kind of rent increases, there's just a lot of onus today to make sure that if a building has a regulatory history, that there is a bulletproof paperwork trail to back up bringing that building out of regulation. And I'll give you an example of something we worked on that unfortunately we didn't wind up closing. And we like to have all this stuff up front, right? Like, so if we're bringing a property to market or a portfolio to market, we have a due diligence checklist that we're telling the owner, hey, give us, your rent roll, give us your expenses, give us any kind of documentation that shows these properties have been deregulated. We have it all in a Dropbox, so it's all there. So we brought a portfolio to market down in Soho a few years back. These were IMD properties. So what an IMD is interim multiple dwelling, which the building was originally a commercial building, a factory or a boutique manufacturing loft where people started living in them. And a lot of these buildings maybe aren't legal to live in. They don't have kitchens. They may not have bathrooms. But there's a business model around legalizing these buildings and turning them into traditional multifamily. So we had a portfolio down in Soho, down in Tribeca, 45-year ownership that wanted to sell. We brought them to market. We ran a process. We had bids above where we had valued them. We went into contract with a group, and during due diligence, lo and behold, the group's law L&T attorney went through all the deregulation paperwork. And it turns out that on a couple of the tenants that had got bought out 40 years ago, they had some paperwork, but not all the paperwork. And the L&T attorney flagged this as saying, this could, not will be, could be an issue with the law board when you apply to get the buildings legalized. And they also said that you could go to 10 lawyers, 5 would tell you that it's an issue, 5 wouldn't.
Hmm.
But the buyer didn't want to take the risk. And the buyer ultimately said, look, I can't do this deal. I'm not going to take the risk of not being able to regulate these buildings because if I can't, the offer that I'm paying today, the properties are worth half that. So,
I
and
see.
I was like, I can pay you half that. And then if once I get through the legalization process, pay the other half. But the seller wanted nothing to do with that. And the deal died. So, unfortunately, sometimes you don't know until you know, even if you think you know. But until you actually get a lawyer that you're spending money to run through this stuff, and even then, it's an interpretation of a murky law that one person may think it's accountable and another person may not. Unfortunately, sometimes you run into that. And that was something that happened in that regard.
Yeah. I mean, and that just speaks to how nuanced the transaction can be, right? And, it speaks to kind of the philosophy that we always promote, which is control as much as you can control because there's so much out of your control, especially in the example of what you just gave in terms of even if you do the right thing, depending on who you hire to do the interpretations can be different and greatly affect the valuation, what you think you're willing to pay when you factor in the risk that's involved and when you factor in everything else, right? So, it is a very nuanced industry that we're in, transaction experience that we're in. And it brings kind of to begin wrapping this up, just what the whole crux of the show is, which is, start with the close in mind, right? And one of the things that you just mentioned is documentation, right? Which is interesting because it's not the first time I've heard that. And you're emphasizing the importance of that. Where something as simple and fundamental as documentation can greatly impact how you end up either disposing of an asset or from the other lens of it, how you go into looking to buy into an asset. So, are there any other things that you can think of that would fall in line? Maybe, another kind of fundamental aspect like documentation or just anything else that you've seen through the year in terms of, what you would tell who is to somebody who's looking to sell the property and they're hiring you. Like, what are normally the first 3 things you're asking? Documentation and what else?
Well, why do you want to sell? What's the reason? Is it something like I'll sell if I get my number, but otherwise I don't need to sell? Or is there an actual story behind it? I need to redeploy proceeds. My business partner and I are splitting up. A lot of times you'll see it in development products. The developer will their capital is really geared towards being recycled into additional. They make their money building, not operating. So a lot of times they'll say the building's stabilized now. I'm not an operator. I want to recycle this capital into my next project. But there has to be a compelling reason. And I'll tell you more because there's volatility today, because the capital markets have been a little over the place. You've seen a big run up in treasuries over the last 6 weeks, given the macro environment. People on the buy side are a little bit on their heels. And a lot of times, in order to get something through investment committee or through the firm's powers that be, there has to be some sort of narrative behind the deal. Why is this a good deal? Why is the seller looking to sell? So a lot of times we want to know, well, not all the time. We want to know why is it you want to sell the property? So that's always a question that needs to be answered.
Right. The motivation.
Yes, there's got to be motivation. If you're not motivated to transact, for the most part, this isn't 2012 to 2018 where interest rates were nothing, and a lot of times you could just let something sit on the market. Eventually, the market would catch up to you. But that's not the way it works today. There needs to be a real conviction on the buy side that they can make money by buying this deal, or they're not going to buy it. Motivation's obviously key and king, but and we just try to be as transparent as possible. We're always telling an owner what we think it's worth before we're going to market. We're always making the disclaimer that what we think it's worth is not what the market may or may not think it's worth. We think it is. Sometimes the market's going to be above us, and we've spoken about that. Sometimes the market, unfortunately, will be below us. Unfortunately, real estate, it's a little different than trading where, fractions of a second, I would do 100 trades a day. Here I'm lucky if we do 12 a year. Real estate manifests itself over months to years. Sometimes people have too much time to think,
Yeah,
and they come up with reasons not to do a deal.
exactly.
Unfortunately, there's too many variables that can change while you're in the market that can ultimately determine value. They can be bureaucratic. They can be dealing with capital markets. There can be a lot of different things that influence supply and demand. But ultimately, there could be a fire in the building. There's a million things that could happen to make a deal not happen.
Yeah.
And so again, like as you mentioned, control what you can control. And we put our cards on the table. We want to build trust with our relationships are everything in this business. I'm sure that's something you've heard a gazillion times, and it's the truth. You don't build relationships by not building trust. So we are upfront. We offer reasonable valuations. We never overvalue something for the hope of getting the assignment because we're not in the business of listing things. Listing things is not where we make money. We make money on transactions.
Right.
So we always put our eyes in the eye. We put our eyes in the eyes of the investor. And if I'm buying this, where do I value it? Why do I want to buy it? And am I going to feel good about it?
Yeah.
And sometimes, a deal needs to be made. Sometimes a deal has reached a point where there's nothing more to do when both sides don't feel good about it anymore, but you get the deal done.
Yeah.
So yeah, it's just, transparency, honesty, integrity, and just trying to uncover and account for every variable that you can control is what we try to do.
Yeah, I love that. It's, you could also kind of extrapolate, say the value isn't in the listing, the value is in the transaction, right? Because at the end of the day, it's what it's transacted for. So really good insight there, Chad. Chad, we're going to wrap up. Thanks so much for your insight. We learned so much about just what value really is, and value means a lot of things. The timing is a part of it. It's, macro dynamics. It's, what the market's looking for, what finance allows you to buy, your track record, best use. There's just so many things that go into value. So it really, really does pay to have, the expert there to help you, especially one who has had the experience with so many different types of executions and asset classes. So I suggest that anybody who's listening to this reach out to you. Where can listeners find, you and learn more about Adirondack Capital?
Sure. So AdirondackCapitalPartners.com is our website. My contact information is listed there. I'm on LinkedIn. Feel free to reach out and connect. Happy to chat with anybody about anything at any time.
Thank you again, Chad. And folks, we look forward to seeing you on the next episode. Chad, thank you for being part of this one.
Thanks so much.